Tulip Mania. The tulip arrived in Europe from the Ottoman Empire in the mid-16th century, quickly becoming a symbol of exotic beauty and wealth. Originally a rare garden ornament, its true allure intensified with the peculiar phenomenon, the broken tulip. A virus, unknowingly transmitted, caused vibrant streaks and feathering patterns on the petals, transforming a single-colour bloom into a unique, living artwork. These broken bulbs, particularly the Simple Augustus variety, became incredibly prized, the rarity fueling an escalating demand. By the 1630s, the Netherlands, a thriving economic powerhouse, saw this fascination turn into an obsession. People began trading tulip bulbs not just for their beauty, but for their perceived future value. The market shifted from actual flowers to promissory notes for bulbs, often still in the ground. Prices skyrocketed. A single Semper Augustus bulb, at its peak, reportedly exchanged hands for the cost of a grand house on Amsterdam's canals, or a dozen acres of prime land. Merchants, artisans, and even farmers poured their savings and borrowed heavily, convinced they were investing in an asset that would only ever appreciate. The initial buyers were real connoisseurs, but the market soon attracted pure speculators, driven by the thrill of quick riches. Everyone saw their neighbours getting rich and rushed to join. The price increases became self-fulfilling, detached entirely from the flower's intrinsic worth. This wasn't about the beauty of a petal anymore, it was about the dizzying potential for profit. The bubble inflated, pushed by a collective delusion that prosperity would last indefinitely. What would happen when the music stopped, and the last person was left holding the most expensive flower in history? South Sea Bubble, the year is 1720. Britain carries a crippling national debt, largely from the War of the Spanish Succession. Against this backdrop, the South Sea Company, founded a decade earlier, promised a solution. Ostensibly, it held a monopoly on trade with South America, continent then largely controlled by Spain, making real trade difficult. Yet, the company presented itself as a path to immense riches. Its bold proposal was to assume a significant portion of the national debt from the British government. In return, the government would pay the company interest, and creditors would exchange their secure, low-interest government annuities for South Sea stock. This offer ignited a speculative fervour. The public, dazzled by tales of New World wealth, flocked to invest. Shares that began the year around £128 soared to over £1,000 by August. This dramatic rise fueled a broader market madness. New companies, some legitimate but many outright frauds, sprung up, offering shares in ventures as vague as for carrying on an undertaking of great advantage, but nobody to know what it is. The South Sea Company itself contributed to the frenzy, even offering loans for people to buy more of its own stock. But the incredible valuations were unsustainable. As the summer wore on, doubts began to surface. People started to sell, cautiously at first, then in a cascade. The price plummeted, driving down the entire market. Fortunes vanished overnight, leaving countless investors ruined. The South Sea Bubble became a stark lesson in the intoxicating allure of easy money and the devastating consequences when belief outpaces reality. It left a lasting scar on the nation's financial landscape and prompted questions about human behaviour that echo even today. Panic of 1873, America in the early 1870s pulsed with ambition. A vast railroad network was under construction, connecting distant coasts and opening up new territories. Congress fueled this boom with massive land grants, and investors, both domestic and European, poured money into railroad bonds. J. Kirk and Company, a powerful Philadelphia banking house, became the year's financial titans, largely by bankrolling the ambitious Northern Pacific Railroad. But this rapid expansion masked deep instability. Many railroads were built on speculative hope, not actual demand. Returns were slow, and the capital influx began to dry up. Europe, facing its own economic woes after the Franco-Prussian War and a severe stock market crash in Vienna earlier in 1873, started pulling its investments from the American market. This left railroad companies, already teetering, desperate for funds. J. Cook and Company, heavily invested in the Northern Pacific, found itself severely overextended. They could no longer sell the railroad's bonds, their primary source of capital. On September 18, 1873, the inevitable happened. J. Cook and Company declared bankruptcy. The news sent shockwaves through Wall Street. Other banks, fearing runs, began hoarding cash. The New York Stock Exchange, overwhelmed by panic selling, closed its doors for 10 days, an unprecedented move. The contagion spread quickly. Hundreds of banks and businesses across the nation failed. Factories shuttered, throwing countless workers out of jobs. What began with the collapse of a single banking giant spiraled into a devastating economic depression that would grip the nation for the next 6 years, reshaping American industry and society in profound ways. Panic of 1907, the year is 1907. America's economy hummed with activity, but its financial system remained a fragmented landscape of independent banks and trust companies. There was no central authority, no national safety net. Confidence was the currency, and it was about to be tested. In October, a failed speculative maneuver involving the United Copper Company stock sent immediate tremors through Wall Street. The collapse directly implicated the Knickerbocker Trust Company, a prominent New York institution. Whispers of insolvency quickly turned into a roar. Depositors formed lines stretching block after block, frantically demanding their cash. The Knickerbocker buckled and closed its doors. This single failure ignited a wider conflagration. Panic surged through the financial district. Other trust companies, then banks, faced similar runs as people, grouped by fear, withdrew their funds en masse. The stock market plunged, credit evaporated, and businesses found themselves unable to access vital capital. The entire system threatened to unravel. With no central bank to provide emergency liquidity, the country's economic fate rested largely on one man, J.P. Morgan. He convened a gathering of New York's most influential financiers, famously locking them in his library until they agreed to pool their resources. Morgan's syndicate injected tens of millions into struggling institutions, propping up the New York Stock Exchange and averting total collapse. He even personally orchestrated a crucial loan to save the city of New York from bankruptcy. The crisis underscored a stark truth. The world's leading industrial nation relied on the improvised actions of a private banker to prevent financial ruin. This vulnerability exposed during the Panic of 1907 would soon force a fundamental reimagining of America's financial infrastructure. Wall Street crash of 1929. The 1920s, a decade synonymous with prosperity and innovation, saw millions drawn into the surging stock market. Dreams of quick wealth fueled unprecedented speculation. Everyday citizens, alongside seasoned investors, poured their savings into stocks, often borrowing heavily to do so. This practice, known as buying on margin, amplified potential gains but also magnified losses, building a fragile financial bubble detached from the underlying economic fundamentals. Initial tremors began in September 1929 as prices softened, but the true earthquake struck on Thursday, October 24th. As the trading bell rang, a torrent of sell orders overwhelmed the New York Stock Exchange. Share prices plummeted, erasing billions in paper wealth within hours. Desperate brokers watched their clients' fortunes vanish. In an attempt to stem the tide, leading bankers pooled resources, buying up large blocks of shares to signal confidence. This intervention offered a brief, deceptive calm. The following Monday, October 28th, christened Black Monday, the market suffered another catastrophic fall. Then came Black Tuesday, October 29th, the day the bottom truly fell out. An unprecedented 16 million shares were traded as a wave of sheer panic gripped Wall Street. The ticker tape ran hours behind, hopelessly overwhelmed by the sell orders. Fortunes evaporated. The crash didn't just wipe out investments, it shattered public confidence in financial institutions and ushered in an era of profound uncertainty, setting the stage for the most severe economic downturn in modern history. Black Monday 1987, October 19, 1987, began like any other Monday on Wall Street, but it would end as Black Monday, the worst single-day stock market crash in history. The Dow Jones Industrial Average plummeted 508 points, a staggering 22.6% decline. Leading up to this day, the market had seen a prolonged bull run, yet underlying tensions were building. The US faced a widening trade deficit, the dollar was weakening, and interest rates were on the rise. These factors contributed to a sense of unease. Adding to the volatility was the widespread adoption of portfolio insurance, a sophisticated trading strategy. This involved computer programs designed to automatically sell futures contracts when stock prices fell, intended to protect large investment portfolios from losses. When trading commenced, an initial round of selling triggered these automated programs. The systematic selling, in turn, drove prices even lower, initiating a destructive feedback loop. The sheer volume of sell orders overwhelmed market makers, who struggled to find buyers or provide liquidity. There were no circuit breakers then, no mechanisms to pause trading and allow for calm. On the floor of the New York Stock Exchange, chaos reigned as prices free fell. By closing bell, the world's leading markets had collectively shed trillions. While the immediate aftermath saw swift policy responses to stabilize the system, Black Monday stands out. It was a unique, sudden collapse that lacked the clear, single trigger like previous crashes. Its origins are still debated, leaving us to consider the complex interplay of human psychology and emerging technology in financial crises. Asian financial crisis. The storm began in July 1997, not with thunder, but with a currency collapse in Thailand. For years, the Thai baht had been pegged to the US dollar, attracting massive foreign investment into a rapidly growing economy. But much of this capital flowed into speculative ventures, real estate bubbles and unhedged loans. When foreign lenders grew nervous about the economy's health and the mounting current account deficit, they began pulling their money out. Hedge funds saw an opportunity, launching massive speculative attacks against the baht. The Bank of Thailand tried to defend its currency, spending billions in foreign reserves, but the pressure was too immense. On July 2, 1997, the government was forced to float the baht, which immediately plummeted. This wasn't just a Thai problem. The shockwaves quickly radiated across the region. Countries like Indonesia, South Korea, Malaysia, and the Philippines, sharing similar vulnerabilities, large short-term foreign debt, weak banking sectors, and fixed exchange rates soon faced their own versions of the crisis. As investors panicked, they withdrew funds en masse, triggering a cascade of currency depreciations, stock market crashes, and bankruptcies. The International Monetary Fund stepped in with bailout packages, but these came with strict conditions, often exacerbating social hardship in the short term. The crisis exposed deep structural flaws in these seemingly robust Asian tiger economies, forcing a painful reevaluation of their growth models. Russian financial crisis 1998. By the summer of 1998, Russia's post-Soviet economy teetered on the brink. Years of privatization and market reforms had brought instability, not prosperity, for many. The government was heavily reliant on short-term, high-yield bonds called GKOs, selling them to both domestic and international investors to fund its operations. This created a massive pyramid scheme, needing constant new money to pay off old debts. Then, the dominoes began to fall. The Asian financial crisis, starting in 1997, sent shockwaves globally. Commodity prices plummeted, including oil, Russia's primary export. Investor confidence evaporated, leading to a mass exodus of capital. Foreign investors pulled their money out of the vulnerable GKO market, refusing to roll over their maturing bonds. The government found itself unable to borrow new funds, trapped by its unsustainable debt. On August 17, 1998, the inevitable happened. Russia defaulted on its domestic debt, including the GKOs, and devalued the ruble, letting it float freely against the dollar. This move wiped out the savings of ordinary Russians and shattered the banking system. Banks, holding huge amounts of defaulted GKOs, collapsed overnight. Businesses faced immediate ruin as their foreign currency debts became astronomical. Panic swept through the nation. Supermarket shelves emptied as people frantically bought goods before their money became worthless. The default was a devastating blow to Russia's fragile economy and its standing in the global financial system. It forced a painful reset, exposing the deep flaws of its nascent capitalism. .com bubble burst. By early 2000, the internet's dark frenzy had reached an unsustainable peak. Money poured into any company with a com suffix, often ignoring basic financial metrics like revenue or profit. Then, the first serious doubts emerged. On March 10th, the Nasdaq Composite, heavily weighted with these tech stocks, hit its all-time high. What followed was not a gentle correction, but a dramatic, rapid collapse. Investors, finally questioning the viability of companies with massive valuations but no clear path to profitability, began to pull their money out. The selling accelerated, turning into a panic. Within weeks, billions in market capitalization vanished. Many startups, having burned through venture capital with no sustainable business model, simply ran out of cash. Their grand visions of a new economy dissolved. Companies like Wevan, eToys, and Petscom became immediate cautionary tales, their ambitious online-only strategies proving fatally flawed in the absence of actual customer demand or efficient logistics. The bust triggered a brutal wave of bankruptcies and massive layoffs across the tech sector, impacting not just Silicon Valley but every region that had embraced the internet gold rush. Thousands lost their jobs, and investor confidence plummeted. The once celebrated promise of rapid, easy wealth turned into widespread financial loss. This wasn't just a market downturn, it was a fundamental re-evaluation of the internet's commercial potential. The dream of effortless riches faded, forcing a harsh return to established principles of revenue, profit, and tangible value. The dot-com bubble burst served as a stark, expensive lesson, fundamentally altering how investors and entrepreneurs approach the digital frontier for years to come. Global Financial Crisis 2008. The seeds of the 2008 global financial crisis were sown years earlier, in a housing market supercharged by easy credit. Lenders offered subprime mortgages to borrowers with poor credit histories, often with little scrutiny. These loans, individually risky, were then bundled together into complex financial products, mortgage-backed securities, and sold to investors across the globe. Wall Street banks further obscured the risk, creating even more elaborate derivatives like collateralized debt obligations, or CDO, often given deceptively high ratings by agencies eager for business. When the housing bubble finally burst, beginning in 2006, the intricate web began to unravel. House prices plummeted, and homeowners found themselves owing more than their properties were worth. Foreclosures surged, turning those supposedly safe mortgage-backed securities into toxic assets. Banks holding these now worthless investments faced massive losses, quickly eroding their capital. Trust vanished from the financial system, bringing interbank lending to a standstill. The crisis hit its peak in September 2008. Investment giant Lehman Brothers, burdened by its toxic assets, collapsed, sending shockwaves through markets worldwide. Insurer AIG, facing billions in payouts on derivatives linked to these very assets, required an unprecedented government bailout to prevent its own collapse. The freezing credit rapidly spilled beyond the financial sector, choking off lending to businesses and consumers alike. Factories idled, jobs disappeared, and the world plunged into its deepest recession since the Great Depression. The crisis laid bare not just the dangers of unchecked speculation, but the profound interconnectedness of the global economy and the fragility of trust. The European sovereign debt crisis. The tremors of the 2008 global financial crisis eventually reached Europe, exposing a critical vulnerability: the massive government debts accumulated by several Eurozone members. What followed was the European sovereign debt crisis, a period where market confidence evaporated, threatening the very existence of the single currency. Nations like Greece, Ireland, Portugal, Spain, and later Italy, found themselves unable to borrow money at sustainable rates. Years of overspending, coupled with the economic downturn, left them with precarious finances. Investors, suddenly nervous, demanded higher interest rates on government bonds, or simply refused to lend altogether. Greece, with its historical budget irregularities and high debt-to-GDP ratio, became the flashpoint in late 2009. The fear was palpable: a Greek default could trigger a domino effect, pulling other heavily indebted nations down and shattering the Eurozone. To prevent this, the European Union and the International Monetary Fund orchestrated unprecedented bailout packages. But these lifelines came with stringent conditions: deep cuts to public services, significant tax increases, and painful structural reforms collectively known as austerity measures. These policies, while designed to restore fiscal health, led to widespread social unrest and economic hardship in the affected countries. Unemployment soared, and public resentment against the perceived impositions from Brussels intensified. The crisis highlighted a fundamental flaw in the Eurozone's design: countries shared a currency but retained independent control over their national budgets. This created an imbalance where a crisis in one member could imperil the entire system, forcing difficult choices about shared responsibility and national sovereignty that continued to echo across the continent. COVID-19 market crash. As COVID-19 began its relentless spread across the globe in early 2020, governments scrambled, instituting unprecedented lockdowns and travel bans. This sudden, forced halt to economic activity triggered an immediate and brutal response from financial markets worldwide. Investors, gripped by profound uncertainty and fear of a prolonged global shutdown, began a rapid sell-off across all asset classes. The major indices reacted violently. Between February 20 and March 23, 2020, the S&P 500 plunged by 34%, marking one of the fastest market corrections in history. The Dow Jones Industrial Average experienced its largest single-day point drop on March 16, shedding nearly 3,000 points. Trillions of dollars in market value evaporated within weeks. Volatility, measured by the VIX index, soared to levels not seen since the 2008 financial crisis, reflecting the pervasive panic. Businesses shuttered their doors, supply chains fractured, and unemployment claims skyrocketed at an unprecedented pace. The core fear wasn't just a recession, it was an unknown duration of economic stasis, an artificial calm for the global economy. Unlike previous crashes driven by financial imbalances or asset bubbles, this downturn stemmed from a direct, external shock, a global pandemic that forced the world to simply stop. Policymakers and central banks now faced the immense challenge of cushioning an economic blow unlike any they had ever prepared for.